Okay, hi everyone. Can hear me? Yes, and can see a screen as well. Yes, no. Yeah, can. Okay, so we'll wait for let's say 1 to 2 minutes. We'll see if the others also come in, and then I'll start. So you can take in around 2 3 minutes to join. So if you'll have any friends on the group and not yet here, just ask them to join as well. And anyway, this account can't accommodate more than 100. So the first 100 who comes in will be there. Yeah. Okay. Right. I know it's been some time since we did unit number 4. Hope you'll have not forgotten, right? Because I want to finish this thing ideally very, very faster, but it is taking more time than I actually anticipated it to. I was ideally wanted to finish this entire BYC from somewhere around in March, but I don't think we can finish it in March. I'm looking at, let's say, another 2 to 3 months, right? Might go to finish all. So we'll see how it goes, right? We might maybe chapter maybe 11, 12 and stuff. We might not do the essay questions, but apart from that, all the others, even slowly, little by little, before you all do A levels, we'll somehow try and finish it off, right? So I know the amount of participation has anyway dropped, but today I can understand because it's like a separate day. So ideally, we'll finish this unit today, right? And then what would happen is next Sunday, that is our usual time, Sunday 2 to 4, we'll start with unit number 5, right? That is national income accounting. Now, national income accounting, there is not a lot of questions, right? Because national income account, do you all want to do national income accounting and macroeconomic equilibrium together, or do you all want to do it separately? I'm okay with any of it. 5 and 6 together, or shall we do it separately? Together is easy. I also felt together is okay. Separately together. Okay, that is okay. Separately. Okay, so then we'll see. I'll just. Okay, do you all want to vote? Okay, I don't have a poll. Okay, so I'll just check. Okay, I don't have a poll to vote. What we'll do is I'll check with you all, right? Yes, today's recording, I will provide it on the group because today's class is anyway a class that I changed the date now. So I have to be fair with that also. So I will provide the date, not the date, the recording. Unit 5 and 6 will see because sometimes in Unit 5 and 6 in the new papers, there is only like one essay question. So it's like easier if you do both together. But never mind, we'll try to do it separately. So we'll first do unit number 5 and then do unit number 6. So we'll be doing unit number 5 this Sunday. So please make sure now national income accounting, sometimes all the past paper questions also you all can't attempt because some are out of syllabus because national income accounting, there were a lot of changes recently, right? Therefore, all the questions you all will not be able to attempt, but all the questions that you all know and that you all feel you all can do, please do and come, right? So ideally, what I will try to do is I'll try to finish all the national income accounting MCQs. There is around not much. I think around per paper there'll be around 3 4, right? So within next Sunday, so maybe even we might have a little longer class. I'll try to finish all the MCQs in one go. Right? Usually we take 2 classes for the MCQs. So I'll try to finish all the MCQs by next Sunday. So please do all the Unit 5 National Income Accounting MCQs by Sunday and come. I'll inform in the group as well after this class, and you all have friends on the group, right? So just let them know as well. So I'll be starting from the very beginning, the MCQs. So please do try and come so you all can catch things up. Okay. Right. So last class we finished up to 2016. Yes, if I'm not mistaken, we finished the 2016 paper, right? Completely, or did we stop it halfway? Completely done, right? 2016. Yes, no. Anyone who remembers? Okay, did? Fine. So we'll now start with the 2017 paper, right? The 2017 A level, the question from production and cost and all of it. It's an easy question, right? I saw an interesting question in the 2020 paper. So we'll get there, but for now, we'll just go through whatever that is there over here, right? Okay. So, guys, I'm not going to go very much in detail, right? Because I have covered all of these, most of this, right? There is nothing new that I have to cover. Almost everything that I've covered, that is there in these questions were covered either in the MCQs or in the previous essay question discussions, right? Okay. So question number one, how does the law of diminishing returns relate to the shape of the firm's short run cost curves, right? So how do you approach this question? Now to approach this question, remember, they're asking you, how does the law of diminishing returns relate to the shape of the firm's short-run cost curve? So maybe you can start off with, right? You can start off with, let's say, a small introduction of what the law of diminishing returns is, right? You might get 1 mark for that. So you say, law of diminishing returns is where in the short run, when a firm keeps on adding variable inputs to a fixed factor, right? The marginal product eventually starts to fall or starts to fall after some point, whatever definition that you know, you write. And then you first talk about, right? Now, don't directly go into the short run cost curves because the law of diminishing returns explains the short run product curves. No, it explains this. No, right? It explains the how this marginal product, average product, total product, how that behaves, right? That is what the law of diminishing margin returns explains. So first you can say, right, initially, when you increase variable input, let's say the marginal product and the average product starts to increase. You can say after a certain point, when uh, in the second stage, when diminishing return starts to affect, right, the marginal product starts to fall, right? You say that. And then after that, you say if you continue to add input, the marginal product becomes negative. Now you will be wondering why are we explaining the about the product curve when they are asking about the cost curve, right? They are asking firm short run cost curves. Then what you say that these product curves are mirror images, right? The cost curves are mirror images of the product curve. So you can say, as explained before, when the marginal product is increasing, the marginal cost curve is decreasing. When the marginal cost is increasing, the marginal product is decreasing. Then you can same way say the average product and the average variable cost curve are again mirror images. So when this is increasing, the average variable cost is falling. When the average product is falling, the average variable cost is increasing. And you can also say this intersects this at the topmost point, this intersects this at the bottommost point, right? So a thing like that, you can maybe draw the diagram also if needed, and then you would get your full marks. Now, the same question that they're asking you in different ways. Every single year, they're asking this in a different context, right? Is that fine? Yes, no? Law of diminishing returns and the shape of the cost curves. Yeah. So you simply talk about the increasing, decreasing, and thing like that, right? Yes, no questions? Fine, yeah. Okay, I'll repeat it once. So how can you start off? You start off with one, defining what the law of diminishing returns is, right? Whatever definition that you've studied. Then you start off explaining about the product curves, right? You say when the marginal product is increasing, right? Initially the marginal product will increase, then it will start to fall, right? You explain that. And then what you do is you say that the marginal cost curve is a mirror image of the marginal product. So as long as the marginal product is increasing, the marginal cost curve will fall. As long as the marginal product is decreasing, the marginal cost will start to increase. Same thing you say with the average product. So that will give you a good answer. That will make a good answer for this, right? So guys, now these type of questions, the only way you can practice is by writing right answers. There is no point listening to me and doing that, right? You listen to me, understand what is there. I hope you have written at least, right? Write these, practice writing these answers, right? Then it would make you much more confident and you would be very, familiar with it, right? Uh, my friend, CTC needs a recording. For sure, will you send? Yes. If I say I'll send, guys. Don't worry. I'll upload the recording to a Google to the Google Drive and send the link on the group. Don't worry. Unless my something happens to my recording, I would provide it. Unless there is some technical failure and the recording is gone, then I'm very sorry about it. But as long as I have the recording, I will give the recording. Don't worry. Okay. Okay. Question number 2. What happens to the difference between the average total cost and the average variable cost as the firm's output expand in the short run? Explain. Okay. Before you explain, tell me what happens to the difference between the average total cost and the average variable cost. Forget the explain part. What happens? The difference between the ATC and the AVC when the firm's output increases, exactly, it decreases, guys, right? So the difference between, okay, here I have a diagram, right? So if you can see this diagram over here, right, this axis is the output, right? So whenever the output is increasing, when the output keeps on increasing, what is happening here? Check this one. This is the two curves that I'm talking about, right? AFC, this curve, right? Sorry, not AFC, AVC, the average variable cost, and the average total cost, this curve. So the gap between this, initially it's very high, right? Then it decreases. It decreases more, right? It decreases and decreases and decreases. It keeps on decreasing. Do you think that the ATC and AFC will meet at one point? Will they, like, if you continue this, do you think they will meet? They will intersect? Will they intersect or not? Why won't they intersect? Why? Exactly. Guys, this will not intersect because the difference between the average total cost and the average variable cost is the average fixed cost. You all know this, no? Right? You all know the basics. How is average total cost made? ATC, right, is equal to AV, average variable cost, plus the average fixed cost, right? This is how it is comprised of. So as long as now this ABC, the average variable cost, it might come very closer to the average total cost, but it will never be equal to it. Why? Because there is always an average fixed cost. Because there is a fixed cost no matter how much you produce, right? Remember, I told you, even if you produce 1,000, 10,000, 1,000,000, whatever amount you produce, the average fixed cost will never be zero, right? There will be some amount of it. So if this is not zero, the average variable cost and the average total cost can never be equal. So what you can say is, right, now I'll come back to the question. You can even draw this diagram when you're explaining the question. So in the question, they're asking you, right, what happens to the difference between the average total cost and the average variable cost as the output expands? So you can say, first you can start off by saying, right, the difference between the average total cost and the average variable cost is the average fixed cost, right? So as when the firm expands its output, right, since the average fixed cost tends to decrease, right, the gap between the average total cost and the average variable cost starts to fall, right? So in other words, or you can say anything, right? You can write it in your words, right? You don't have to write exactly what I'm saying. So you can say, right, when the output increases, or as output keeps on increasing, the gap between these two fall. And then you can also say, due to the existence of a fixed cost, right, the average fixed cost will never be zero. In other words, the average total cost and the average variable cost will never be equal to each other. The gap between the two will keep on decreasing, but it will never be equal, right? So something like that along with the diagram, I think, is a good answer to get your 4 marks. Firm's average cost decreases because the firm uses variable fixed input. No, why does the firm average cost decreases, guys? Sorry, why does the firm's AFC decrease? Remember, I explained this before. Let's say, right, in the short run, your what inputs are fixed, no, right? So let's say, give me a second. Okay, so let's say you had a fixed cost, right? Let's say a fixed cost of, let's say, 100,000, right? Fixed cost of, I'll say 100,000. So when you keep on expanding your output, right? How do you find average fixed cost? Average fixed cost is your fixed cost divided by your quantity. So if you're producing, let's say 1,000 units, then it's 100,000 divided by 1,000. Your average fixed cost is then 100. Let's say you're producing 100,000 units, then your fixed cost is 100,000. Average fixed cost is 100,000 divided by 100,000. Then it's only 1. So as the, what happens, since fixed cost is not changing, when you keep on increasing your output, right, in the short run, the fixed cost gets divided between many outputs now, right? So that is why the average fixed cost keeps on decreasing. Okay, but it will never be zero. Even if this is, let's say, 100 million or 100 billion, it will still be 0 point something something something, but it will never be zero. Okay, so you don't have to really go and include that reason, because they are not asking really about the fixed cost. So you don't have to go into that detail, because the question is asking you the difference between the average total cost and the average variable cost. So that amount of detail, I feel it's not really needed. So that's question number 2. Fine, yes, no, 1 done, 2 done. Okay, right. So then we move on to question number 3, right? Question number 3 here says, right, it talks about, give me a second. Okay, so question number 3. How would each of the following affect average total cost and average variable cost? First, you have to see whether how it affects, right? So a reduction in the price of electricity. What do you think happens to average total cost? ATC? What do you think happens? ATC, obvious, right? It falls, no? So ATC falls. What happens to AVC? Is electricity a variable cost or a fixed cost? Electricity is a variable cost. So if the price of electricity is falling, what would happen to the average variable cost? The average variable cost will also fall. Simple as that, right? Okay. The second one, reduction in the wage rate. What do you think happens here? Sorry. Same thing, right? Even in the wage rate, wages are also a variable cost. So when the wage rate is falling, the average total cost will also fall, or you can say decrease. And what happens to the average variable cost? Average variable cost will also tend to fall. Okay. Okay. This one, increase in the salary of the CEO. What do you think happens here to the average total cost? CEO's salary is increasing. What happens to ATC? ATC, guys, ATC doesn't decrease, guys. ATC increases. It's a rise in the salary. His salary is increasing. Yeah. So average total cost increases. And what happens to average variable cost? Average total cost increases. Increases or rises. What happens to average variable cost? Does it fall or does it rise? AVC. Guys, AVC, it doesn't change. It's constant. Because why? The CEO's salary is not a variable cost. It's a fixed cost, right? Whether you are producing 1 unit, 100 units or 1,000 units, the CEO will get the same salary. His salary is not dependent on the number of units or number of output the firm is producing. So therefore, your variable cost will not change. So if your variable cost is not changing, how can your average variable cost change? So AVC, you can say no change. Be very, very careful in things like that, right? And then part D, an increase in the cost of rent of the firm's building. What do you think happens here? Rent. If rent increases, ATC. Increase in the cost of rent, guys. When rent increases, ATC increases, right? And then what happens to the AVC, the average variable cost? Average variable cost, there is no change. I'm surprised to see similar answers for 1 and 2 and 3 and 4 then. Guys, can someone check with the behind your past paper book if my answers are right? Because 1 and 2 is giving the same answer, 3 and A and B same answer, C and D is the same answer. Have they explained it in a different manner? Because very rarely you get a question like this. So AVC is decrease in second. Yeah, so that is why I said fall, guys. Fall or decrease, same thing, guys. Same. Okay, so very unusual you'll get a question like this, but if you're 100% sure, guys, don't change your answer, right? So even in 1 and 2, it's like the same thing. Past paper, it says unchanged wage rate. Yeah. Guys, can you check this? I'm not very sure. Reduction in the wage rate, AVC has to fall. AVC says unchanged. Really? This can someone else also confirm? Says fall, right? I don't know. I don't have past paper book with me. I'm kicked out of from my room today. So this is correct. Okay, so we'll just go with this, guys. Fall, decrease, same thing. Rise or increase, same thing, right? Okay, so then these are the answers. Okay, what I just want to double check because you rarely get the same answer. Yes, maybe a mistake in your past paper book then. Okay. Uh, okay, that's an easy question. Now, this was a new type of question that started recently. Whether you know what is happening to these, what you should, what let's say, for example, whether the statement is true or false. They're giving you easy questions like that because now they don't have any questions more to ask. So, okay, why is AVC constant? AVC constant in rent. Okay, so rent is a fixed cost, right? Whether you produce 1 unit, 100 units, 200 units, or 1,000 units, is your rent going to change? No, right? Rent is a part of a fixed cost. Therefore, even if rent changes, your variable cost will not change. So if variable cost is not changing, average variable cost also can't change. Okay, done. Okay, question number 4, as easy as it can get. State two differences between a perfectly competitive market structure and an oligopolistic market structure. Guys, if you all can't answer this, then there is an issue. Okay, differences, two differences. Exactly. Perfect comparison, you can say there's a large number of large number of sellers, but in a oligopolistic market, it's dominated by few sellers. Then you can say in a perfectly competitive market, the product is, let's say, homogeneous, but in a oligopolistic, it can either be homogeneous or it can be what constant. So not constant, homogeneous or differentiated. Then perfect competitive, if you want, you can say there's free entry and exit. Oligopoly, you can say there are some sort of barriers. Guys, third one, why AFC is no change? I explained this, no? Yes, you can talk about price taker, price maker. Yeah. So CEO's salary, right, is not a variable cost. Yes, please listen when I say once. I think I told that, didn't I? Yeah. Okay, CEO's salary, right, is a fixed cost, whether you produce 0 units, 100 units, 200 units, or 300 units, or 1,000 units, or 10,000, right? Your CEO's salary, the amount of salary you pay to your CEO will not change. He does not get paid based on the amount of units the firm produces. He has a fixed salary, right? So the CEO's salary is a fixed cost. So just because the CEO salary increase, yes, the average total cost is increasing because average total cost is a combination of fixed and variable, right? But since CEO salary is fixed, right, the average variable cost is not really affected. So that does not really change. That's why you were saying AFC no change, AVC no change. If they said average fixed cost, then you can say average fixed cost increases. Okay, hoping that is fine. Yeah, so this one you all can write now, guys. State two differences. Fine, price taker, price maker. You can talk about barriers to entry. You can talk about the number of sellers. You can talk about the product, right? You can do all of that. Okay. Then distinguish between normal profit and abnormal profit. What is the difference here? Question number 5. Guys, here now remember there are two normal profits that they talk about in this unit. First of one, in one situation when they talk about normal profits, it is the minimum return the entrepreneur expects. But here when they're talking about normal profit, they're not explaining that, they're not expecting that explanation. There is the other explanation where the total revenue is equal to the total cost. That is what they are wanting here in normal profits. Okay, so what do you write? Okay, so I'll move this to this side. Okay, so in question number 5, what can you write? What is the difference here? Okay, so question number 5, right? When you're writing question number 5, you can say normal profits, right? So normal profits. Okay, my board is stuck. Give me a second. Normal profit, don't take the definition of that minimum profit the entrepreneur expects here, guys. Normal profit here, now when they are comparing normal profit and abnormal profit, then normal profit is where the total revenue is equal to the total cost, right? So when the firm's total revenue is equal to the total cost, we say that the firm is making a normal profit, or in other words, they are making zero economic profit. Then you can say total cost is a combination of both direct cost and indirect cost. Guys, don't write DCIC. Please write the full forms when you're writing in your answer. So you can say this is a combination of both direct cost and indirect cost. So in a situation where the firm's revenue is enough to cover this total cost, right? Cover this total cost, the firm is earning a normal profit. Can we use MR, MC, or TRC? No. Normal profit is not where MR equals MC. That is the profit maximizing output. MR equals MC is the profit maximizing output. Okay, don't confuse that with this. Okay, so you say normal profit is where the total revenue of the firm is equal to the total cost. In other words, it is a situation where the firm is earning zero economic profits, right? And then you can also say total cost is a combination of both direct cost and indirect cost. And then what is abnormal profit then? Abnormal profit. Anyone? Abnormal profit is where? Abnormal profit. Is it a profit or is it a loss first? What is abnormal profit? Guys, abnormal profit is where, right? It's not a loss, guys. Abnormal profit is where your total revenue exceeds your total cost. Go and check your tute, right? So abnormal profit is not a loss. It's more than normal profit. In other words, abnormal profits, another word for this is economic profits, right? Economic profit. This is not a loss. Don't confuse abnormal profit with a loss, right? Supernormal profit is also like abnormal profit. Abnormal losses. What was the word I said in my tune? Give me a second. Um, Subnormal, exactly. That's the word. I forgot the word. Okay, yeah. Okay, so I'll just share what was there on my tune, right? So you have supernormal profits or economic profits. This is what we call abnormal profits, guys. So supernormal, whoever who has my tune, supernormal, economic, and abnormal mean the same thing, right? And then you have normal profits. That is where, I hope you all know the diagrams, where the total revenue is equal to the total cost. And then you have subnormal profit, not supernormal, subnormal, or in other words, abnormal losses, right? So this is why you need to know the different names, right? So if you want, what you can do is you can even draw the diagrams for this, for each of these situations. See, for normal profits there is a diagram, for supernormal profits there is a diagram, right? Now those diagrams you could have drawn and explained as well when you're distinguishing between normal profit and abnormal profit. In abnormal profit, the ATC curve is below the average revenue. Yes, no, yeah. ATC is below. Okay, so economic profits, this is what you have to explain, right? So I'll brief it once again. What you have to do here in this question, normal profits, you start off explaining what is normal profit. That is where the total revenue is equal to total cost. You can say the firm is making zero economic profits. Then you can say total cost is a combination of this and this. Then if you want, you can draw the diagram. Then you start with, let's say, abnormal profits. Abnormal profits, you say where total revenue is greater than total cost, right? Then you can say this is where the firm is making economic profits, or let's say supernormal profits, right? Something like that. Is that fine? Yes, no? If you want, you can add to this. So when the firms are making normal profits, there is no tendency for new firms to come or new firms to go out. But when there is abnormal profits in the market, there is a tendency for new firms to come in, because this industry is doing really, really well. And so maybe some point like that also, if needed. Are we okay? Yes, shape, no? Hmm? Okay, so then we'll go into the next question. Right? So 2017 is done, guys. This is actually a very easy question. Please go through all the questions that is there that we did. We'll be finishing all of it today. No? So maybe today or maybe tomorrow, stay up late at least and try to do it, right? And try to go through everything, right? All these questions and finish it off. Can we say price greater than ATC? Don't really go to price. Talk about average revenue. That would be a better thing. Price is average revenue. You can say average revenue is greater than average total cost. Okay. Okay. So we then come to 2018. Okay. 2018 A level question. Guys, did you all do the questions? Yes or not? Did not do and just having a nice time listening to me? Did, right? Done? Please do it and come, guys. Don't have time. Don't just listen to me, because there is no point. Trust me, it will be like Greek if you are just coming and listening to me, and because I'm pretty sure one reason why the crowd is a little falling off is because they're not doing. Yeah. So just what you have to do, ideally the best to get the best use of this, whatever mass papers that we're doing, is you have to do. And what you do is, when I explain, you see whether the way you thought and I am teaching, is it the same? Are we talking about the same thing? And does it make sense, right? And let's say, what if you have any doubts, then you clarify. This should not be the place where you're learning it for the first time, and this should not be the place where you're doing the paper right now. Okay, to get the best use of it. Okay, question number 3, 2018. State whether the following statements are true or false. Give reasons for your answers. First one, total product starts falling when diminishing returns sets in. Yes or no? Okay, guys, this is basics. Diminishing returns. Which stage of production is it? First stage, second stage, or the third stage in the law of diminishing returns? Diminishing returns. Diminishing returns is the second stage. In the second stage, can you all tell me what is happening to total product? In the second stage, is total product falling? It's not falling, right? Total product is increasing at a decreasing rate. It is reaching its maximum. It's still rising. So this is false.
right? So you say marginal product is falling, yes, but they're asking you whether this is true or false. So total product starts falling when diminishing return sets in is false. 1 mark for that. Then your reason you can say, right? So you can write what is actually happening. So you can say diminishing returns is where, right? The marginal product is starting to fall. Therefore, the total product is still increasing at a decreasing rate. Marginal product is not negative, no, because when the marginal product goes negative, only total product will fall. Because what is marginal product? Marginal product is the addition to the total product, no? So still the marginal product amount is falling little by little, only it's increasing. So therefore, the total product will also still increase, but at a slower rate. So that is what you have to write there. Okay. The easy question for 8 marks. Second one. Does AP and MP both fall? Yes, AP and MP both fall. The second step. Okay. Right. Part B, property taxes, building insurance payments, and amortization payments are fixed costs. Guys, what are amortization payments? I explained this, I think, in a previous class also. What is amortization payment? Exactly. Something like loan installments, right? The installments that you pay for your loan, something like that. Okay. So property taxes, building insurance, and amortization payments, are they fixed costs? Is that true or is that false? That's true, right? So whether it's a fixed cost or not, how do you find out? Just think. Depend. Will this cost change based on the output, based on the amount of goods I'm producing? Will my tax, property tax? No, no. Maybe tax on goods might change based on the output I'm producing, but will my property tax change? Whether I produce zero, whether I produce 100 or 1,000, for the property that I am there, I have to pay a fixed amount of tax. My insurance, building insurance, will that change? No. Amortization payment is like my loan repayments. If I'm producing 0, 100 or 200, that is also not going to change. So these costs are fixed costs. So you say true, and then you can say costs such as property taxes, building insurance, and amortization payments does not change with the level of output. Therefore, are considered as fixed cost. That can be your reason there. Okay. Okay. Part C. Diminishing returns and decreasing returns to scale are different ways of saying the same thing. Yes or no? True or false? False, right? This is false. It's not the same thing. It's not two words for the same thing. It's completely different. So you can say diminishing returns is in the short run where the marginal product is starting to fall now, right? And decreasing returns to scale is in the long run, right? Where when you increase your input, your output is increasing by a lesser proportion. It's not saying the same thing. It's talking about totally different things, right? So your reason should be, you simply say what diminishing returns is, simply say what decreasing returns to scale is. That's all that you have to do that. Fine. Okay. And then the fourth part D, if marginal cost is above the average variable cost, marginal cost must be falling. Simple thing comes from the diagram. True or false? If MC is greater than ABC, true or false? Guys, how does the diagram look? MC, ABC, marginal cost. When it's greater than ABC, what is happening? The marginal cost is rising, no, it's increasing. So that statement is false. Statement is saying that if marginal cost is above average variable cost, marginal cost must be falling. No, 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 guys. Can you see? When it's above the ABC, this part of the diagram, right? The MC is actually increasing. It's not falling. Okay. So you say, sorry. Okay. What do you say? If marginal cost is above average variable cost, marginal cost be falling. First thing you say false, 1 mark for that, and then you can say, for your explanation, you can say as long as the marginal cost is above the average variable cost, the marginal cost keeps on rising. You can say that. Okay, see, because you had a connection problem. Okay, I'll give you all the recording, guys, so y'all can rewatch it. Okay. Okay. Question 1, 2, 3, and 4. Okay, so okay, I'll explain. See again. So diminishing returns, decreasing return scale are not the same ways of saying the same thing. You can say diminishing returns is where in the short run, right, where the marginal product tends to fall, right? Decreasing return scale, you can say it's a long run concept where when you increase your input, your output increases by a smaller proportion. So it's not the same thing. Voice is breaking. Sorry guys, I can't really do anything. Just try to adjust. I'll give you the recording also. As far as I know, there is no issue on my end. We'll see. Okay. Right. Question number 3. Then explain using 2 examples what is meant by barriers to entry into an industry. Guys, what are barriers to entry? First, you start with what is meant by barriers to entry. You start with the definition. What is a barrier to entry? So barrier to entry, you can say is it's any obstacle or it's any restriction, right? Better word I think is restriction, or anything that restricts a firm from entering a industry can be considered as barriers to entry. So then maybe to explain using 2 examples, first one you can say, what are the examples that you can give for barriers to entry? What kind of barriers to entry are there? Okay, what is a natural barrier? Guys, now when you're picking up 2 facts, make sure you know to explain the 2 facts, right? Just because you know the name of it, don't go because they're asking you to explain that. So what do you think? Okay, ownership of raw materials, legal barriers by the government. So the definition is simply where there is a certain restriction. Barriers to entry means where there are restrictions for a firm to enter into the industry. Okay, so maybe the facts that you can give here, right? Using two examples, you can say one, there is, let's say, okay, what are natural barriers? What is a natural barrier here? Anyone? Natural barriers to entry. What does that mean? Anyone who knows this natural barriers to entry? What does this word natural barriers to entry mean? Okay, nice. Got some answers. Exactly. Guys, natural barriers to entry here means, guys, because of economies of scale. Now, for example, think there is an industry, right, where these people, now, for example, let's say the Sri Lanka Electricity Board, right? They are the ones supplying electricity to the entire country, right? So they are the ones producing electricity in a large scale, right? They produce electricity in a huge scale. They're producing it for the entire country, or let's say even the water board, right? They're producing it for the entire country. So therefore, when they're producing in very large scale, guys, you all know firms experience economies of scale, right? Firms have economies of scale. So what is economies of scale? Anyone? Economies of scale. What does economies of scale mean? Exactly. Economies of scale is where your average total cost decreases. So to, let's say, to produce a unit of electricity, right? To enter a unit of electricity, it's not, it's very cheap for these people. Now, since they have very large scale production, right? Because of the fact that they have economies of scale, the average total cost is very less, right? Now, when a new fellow tries to come in, right? Let's say a new person tries to come in and produce electricity, right? The average cost for that person will be very high because he is still a small scale guy, right? He's still a small scale guy. So it will be very hard for that guy to, remain in this production activity. Why? Because his price will be high, no? Because his average total cost is going to be high. His price is going to be high. No one is going to really buy from him. Now, that is a barrier to entry. Now, good example is things like, guys, sunlight. This the detergent Sunlight, right? They're not, it's not a pure monopoly, but they're kind of like a monopoly, where they have somewhere around, let's say, almost 80 to 90% of the market share, right, of the detergent thing, right? So you have the other small players like you have Rin, you have what are the other ones apart from Sunlight? What do you all use for washing clothes? Okay, there is Surf Excel. Anything else? There was some Diva. I can't remember. Diva, yeah. So all those are small ones, right? Now the main one there is Sunlight. Now for anyone new trying to come and catch this is very hard. Why? Because for them the average total cost is very high. So that is a barrier for them to come and enter. Now these firms who are already there are supplying for the huge market. So they are experiencing economies of scale. The average total cost is less. New fellows coming in, it's very hard. Now, even look at the Sri Lanka biscuit industry, right? It is Maliban and Muncie who is dominating, right? Maliban and Muncie, they have huge amounts of economies of scale, who is but exploiting that, and average total cost is less. Now occasionally you will see new fellows trying to come in, right? There was, I remember at one point Britannia tried to come in. Then there was something called Mom Biscuits or something, exactly, Cherish, right? So there are fellows trying to come in, but they still can't compete, because for them they are a small company. For them the average total cost, now for example, uh, let's say Muncie, right? For Muncie, now let's say a cream cracker, right? They can sell, let's say the cost for them is, let's say, 20 rupees to make a cream cracker packet. They can sell it for, let's say, 50, right? So let's say a new company comes in, right? So let's say this company called Cherish, they also have biscuit, right? They come in to make cream cracker. So for them the cost is, let's say, somewhere around 45 rupees, because they are still a small company. They don't have economies of scale. Just because their cost is 45, can they sell it at a higher price? No, because Muncie is already been selling it at 50. No one will even buy if a new fellow comes and sell it more than 50. So they can also sell it only at 45. So they are sorry, not the 45, let's say 50, right? Maximum they can do is at 50. So therefore the profits that they earn is too less. So it's not that easy for them to survive. For a new business like this, it's not that easy for them to survive. So this is what we call natural barriers to entry, guys. So you can write this, you can explain this, you can say maybe one barrier to entry is what we call natural barriers to entry. This is where, right, firms existing in the industry have, let's say, exploited economies of scale. That is where, right, the average total cost of these firms are very much less. So therefore a new firm coming into the industry is not able to match that, right? So it's very hard for them to survive, which acts as a barrier to entry. So no one would really want to come. And now even think of y'all, if y'all are going to start a business, have any of y'all thought of starting a biscuit business? No, right? Because you know you can't compete with those guys. So simple as that, right? That is what that means. Economies of scale means average total cost decreasing. Why we consider as barrier? So it's this, right? Now I'll explain this again. Now this firm Muncie here, right, for them the average total cost, right, ATC, is just 20 rupees. So they can sell it at 50, right? Now for, because they are a big company, because they have economies of scale, this is very much less. But for a new company, right, who has come in, they don't have economies of scale. So for them, their average total cost, let's say, is 45. So they can earn only a 50 rupee profit. You know what can Munchie do to eliminate this guy completely? Right? So when, let's say, a new fellow comes in, let's say for around 2 months, Munchie can sell their cream cracker, let's say, at 40 rupees. They can give in a promotion. They can say some promotion, and they give it at, let's say, 40 rupees. They can afford to do that because their cost is only 20. So if Munchie can, the 51, if they give it for 40, what happens to this new guy who comes? This new guy who comes, if he tries to match that price of 40, every unit he'll be making a loss. There's no point for him. So that is why it's a barrier to entry. So no one would want to come into that market, because they know Other people have economies of scale. That is how it connects to barriers of entry. Got it? No. When you know there are giants in the industry, right, you will not really want to come in. So it's a barrier to entry. Yes, no. Got it? Okay. So apart from that, what else can you talk about? You can talk about anything else. Barriers to entry, you can talk about, let's say, the government, let's say, issuing the license for only one firm, right? You can, for example, you can say, let's say, Ceylon tobacco, right? For some, now in Sri Lanka, to produce, let's say, all these cigarettes and all of it, it can only be done by Ceylon tobacco. It can't become done by any others. So government has restricted that. So maybe patents, right? Maybe things like, exactly, controlling the raw materials. Maybe only some industries have the raw materials to produce those goods. So things like that, you can just give in an example and you can write. Phone manufacturing, it's also kind of, again, a oligopoly kind of market. No, so even phone manufacturing, there are natural barriers. Should you give real example? No, you don't have to give real examples. You can just say, you don't have to give names of companies or anything. You just have to say, maybe some companies, since they are in the long run, they have economies of scale, and this. Yes, Chip. Question number 3. Okay, done. Okay, so then we are asking this: what is the connection between the supply curve and the marginal cost curve of a perfectly competitive firm? Yes, I explained this before, right? Wasn't this there in the? There was a question in 2013. Supply marginal cost curve and supply curve of the industry. Remember that question where I said there was a tricky question? No idea. Already forgotten. I think it was 2013 which had that question. Yeah, this kind of MCQ also. Okay. So connection between the marginal cost and the supply curve, guys. I'm not going to explain this. I'll just leave the diagram there, right? So you all know the marginal cost curve above the average variable cost curve is the supply curve, right? The reason is because if you can't cover your average variable cost, you will shut down, right? So you will only supply if you're getting a price more than your average variable cost. So therefore, supply curve is the marginal cost curve above this, right? I've explained this so many times before, right? That story. Okay, then you have distinguish between economic rent and transfer earnings. That's a nice question. How to join the class using access key? How to join class using access key? Which access key? Okay, sorry. Oh no, so you don't need it for this. Okay. Second one, did you give examples? Which one? Yes, the two examples I talked about natural barriers as one, and I just told you to explain that, and maybe that is you can talk about raw materials and stuff like that. Okay. Okay, so transfer earnings and then what? Economic rent, right? So what is transfer earnings and what is economic rent then, right? So transfer earnings, okay, first of all, we'll talk about transfer earnings, right? So transfer earnings, according to this diagram, right, it is this purple box. What is transfer earnings? Transfer earnings is the minimum payment, right? The minimum payment a factor of production would require to stay in that production process. Guys, did I explain transfer earnings economic rent in any previous question? Yes, no? Did explain, right? No? Some say yes, some say no. Did explain? No? Okay, so then I'm not going to go into the very basics. I'll just explain in brief. So you all know transfer earnings, okay, 2016. Okay, transfer earnings economic rent and transfer earnings. There are two different concepts. It's not the same thing. So if you look at a factor of production, let's say labor, right? So for a labor, you have the total earnings. So total earnings for the labor is this box, right? So the amount of wages they get paid and the quantity that is exchanged, right? So wages multiplied by the quantity, you get the total earnings of that factor of production. That total earnings, right, is divided into two parts. One of that, right, I'll explain it using this diagram, right? One of that is transfer earnings, and the other part of it is economic rent. So what is this transfer earnings and what is this uh, economic rent? So transfer earnings is the minimum payment. Now, for example, to, let's say, give 1 unit of labor the minimum wage that they would expect, to give 2 units of labor the minimum wage that they would expect, to give 3 units of labor the minimum wage they would expect. That is what we call transfer earnings, the minimum that a factor of production would require in order to stay in that production activity. If not, he will switch to something else, right? Economic rent is what he gets in addition to what is minimum needed, right? For example, to supply 1 unit of labor, he might need, let's say, a wage of only, let's say, 500 rupees, but he actually gets, let's say, a wage of, let's say, 1000 rupees. So that difference between what he actually gets and the minimum is the economic rent. So economic rent in simple terms is the income earned above the minimum payment required. So minimum payment required is transfer earnings. What you are earning in excess to that is what we call economic rent. So that is the part there. What are they asking? So they're asking for the difference between these two, right? Distinguish between economic rent and transfer earnings. And then you can also say now see in my diagram here, economic rent and transfer earnings are equal, right? But here, see, economic rent is less. Here, the economic rent is more. So remember that the economic rent and transfer earnings will depend on elasticity. These are normal diagrams. See, when the supply curve is elastic, the economic rent is less. If the supply, let's say, is perfectly elastic, it's like this. If this is the supply curve, then economic rent will be zero. The entire thing will be transfer earnings. So if the supply curve is, let's say, here perfectly inelastic, then the entire thing will be economic rent. Nothing will be transfer earnings. So the extent of economic rent and transfer earnings depends on the elasticity. You can say elasticity of supply if you want. Okay. Is that okay? Economic rent, I think I explained the thing before also. I've got a perfect answer as well. Are you all okay with economic rent and transfer earnings? Yes, no? Yeah. Okay. So done with that. Then we'll go on to the next question. Okay, do you all do the 2019 old paper? Yes, no, if not, we'll skip it. 2019, the old syllabus paper. Done. Yes or no? No. One done. No. Okay, there's one person who is done. Okay, so I'll do it quickly. Okay, right. Uh, now questions that is already there, guys. I'm not going to explain. Okay, they're saying explain how diminishing marginal returns and decreasing the scale affect a production cost. So easy thing, no? You can say diminishing marginal returns. It is a second stage. In this, show how what happens to the cost curve. So what happens to marginal cost? What happens to, let's say, average cost, right? In the second stage. Then decreasing terms of scale. So you explain what decreasing terms of scale is, and then say this is long run fair. The because of this, there is this economies of scale, and the average cost starts to increase. You can say that. Okay, this question is a good question, right? What effect would each of the following have on a firm's marginal cost curve and its total fixed cost curve, right? Increasing in the wage rate. Can you tell me what happens to the marginal cost curve and the fixed cost curve? Increase in the wage rate. Marginal cost curve. What happened? Just think you all don't have to answer. Increase. If the wage rate increases, what happens to marginal cost? Why it's not clear? I have no idea. Guys, wages is a part of variable cost, right? So every time you're producing, if your wage rate increases, your marginal cost increases. But remember, right? Here they're asking not about the marginal cost, not about the fixed cost. They're asking you about the curve. Curve. Look at this. So can you say a curve is increasing or decreasing? Can't, right? You can say the marginal cost is increasing. Be very, very careful. You can't answer that saying increase or decrease, right? Because in case you get this question, be very, very careful. They might mark you wrong as well. They're asking you what is happening not to marginal cost, what is happening to marginal cost curve, not to total fixed cost. What is happening to total fixed cost curve, right? So curves, you can't say increase or decrease, guys. Curves, you have to say how it's shifting, whether it's shifting the right, shifting the left, shifting up, shifting down. That is what you have to say, right? So be very, very careful in case you get a question like that. If you say increase, decrease, the answer is incomplete. You might not get marks, right? So when the wage rate increase, guys, when the wage rate increases, right? So that means now when I'm going to increase my production by one more unit, now I have to pay higher wages, no? So what happens? My marginal cost increases. So if my marginal cost increases, what happens to my marginal cost curve? It shifts up, right? And then what happens to my fixed cost? My fixed cost does not change. So therefore, my fixed cost curve does not, you can say does not change, right? Then look at the second one, decrease in property taxes. Now, property taxes is not going to affect really your marginal cost. So you can say marginal cost does not change, but property taxes are a part of fixed cost, no? So what happens to your fixed cost? Your fixed cost falls, but they are asking you what happens to fixed cost curve, no? So you say fixed cost shifts down. See, now be very, very specific there. That is what I wanted to highlight in this one. That's why I even put now this is from the original marking scheme, not the past paper answer, from the original marking scheme. See there, say when effects on curves are not mentioned, maximum 2 marks. So when you say increase, decrease, the effect is not clear. So they might not give you the 2 marks then. Okay, be very, very careful. Rise in the purchase price of capital equipment, it does not really affect marginal cost, does not change. Fixed cost will increase. So you can say shift up. Then rise in energy prices is like electricity, right? So if electricity increases, your marginal cost will definitely increase, right? So you can say shift up. Electricity is not a fixed cost. So therefore, fixed cost curve will not really change. So be careful, okay? Then what factors are considered in determining the market structure of a particular industry? Very easy things. Market structure, you look at the number of buyers and sellers, you look at the product, you look at the, let's say, the barriers to entry and exit, exactly, nature of competition, right? You look at the price taking behavior, right? You look at, let's say, the information that is there, right? So those kind of things, okay? What type of demand curve does a perfectly competitive market face? Explain reasons. I think this we did at least around 2 3 questions like this. What kind of demand curve do they face? Perfectly competitive firm, perfectly elastic demand curve. Why do they face a perfectly elastic curve? Why perfectly elastic demand curve? Because the firm is a price taker. Why are the firms price takers? There are 3 reasons for that. Why is a firm a price taker? Because there's perfect information, because they're only a small seller in the entire market, and also there is a homogeneous product. So because of these reasons, the firms are price takers, which means they can sell any amount that is there at the prevailing price. Therefore, the demand curve of the firm is perfectly elastic, right? Thing that we have done over and over again. Okay. Question 5. A perfect company firm could face each of the following situations in the short run. In each case, indicate whether the firm should produce in the short run or shut down in the short run, or whether additional information is needed to determine what it should do in the short run. Okay. So for a firm to uh, wait, stay in the short run or do this, what is the condition? What are we looking at? Whether the firm should produce or whether the firm should shut down. What is the condition we are looking at? Yes, when will the firm shut down? Okay. So one, you can say at least the price should be greater than. Okay, give me a second. I'll make it small. Now this is okay. So price should be greater than average variable cost, or else you can say same thing. You can say in other way, your total revenue should be greater than your variable cost, right? So okay. So this is the condition. So based on this only, we will decide whether a firm should stay or whether they should shut down. Or if this is not clear, you can say that they need additional information. So they're asking to indicate whether the firm should produce. That means whether they should stay in the short run or should they shut down, whether they should leave or whether additional information is needed. Okay, first one. Total cost exceed total revenue at all output levels. Total cost is greater than total output at all output levels. Should they shut down or not? Sure. Should they shut down? Right. Okay. They should shut down when? When should they shut down? Okay. So you should shut down. Okay, this is annoying now. You should shut down when the total variable cost is greater than the total revenue, right? If your total variable cost is greater than your total revenue, then there is no point in staying. Then you have to shut down and go. But here they are saying total cost is greater than total revenue. But do you really know whether the total variable cost is high or not? You don't have information, right? If the variable, if you can't even cover your variable cost, then no point. Then you have to shut down. So here, the first one, right? You should, the answer needs to be whether you need additional information. You can say additional information is needed. So you're not very sure. If you can say if the total variable cost is higher, then it's fine. You can say shut down. First one answer will be additional information is needed. Okay. Second one, total variable cost exceed total revenue. Should you shut down, stay, or do you need additional information to make that decision? Total variable cost exceeds total revenue. That is what I just said. Yeah. So you shut down when your total variable cost exceeds your total revenue. That is what point 2 says. So if your total variable cost is more than your total revenue, you're not even covering your variable cost. So then you shut down. Okay. Okay. Part C, total revenue exceeds the total fixed cost. What happens? Total revenue exceeds the total fixed cost. Continue, shut down, or additional information is needed. Continue. If the total revenue is greater than the variable cost, you would continue, right? So here, what do you think? What is our condition? If the total revenue is greater than the variable cost, we will continue. Or if the price is greater than average variable cost. So here they are saying total revenue is greater than total fixed cost. But we don't really make the decision based on that, right? We make the decision based on the variable cost. If you can cover your variable cost, then you should continue. So if the total revenue, just because it exceeds its total fixed cost, we don't, that does not mean we should continue in production. So here your answer is again, guys, additional information is needed. Part C. If you don't really have all the information that is there. Okay. And then the part D, right? Price exceeds average total cost. Should you stay, leave, or do you need more info? Yes, think. Price exceeds average total cost. Yes, if price exceeds average total cost, guys, you will continue. You will stay. Because if price is greater than the AVC itself, you will stay. Right? So if the price is AVC, if okay, so you all know average total cost is a combination of both of these, no, ATC. Give me a second. ATC is equal to AVC plus AFC. So here, if the price is greater than ATC, that means it is definitely greater than AVC. No? Price, if the price exceeds the average total cost, definitely price is greater than the average variable cost. That has to click here. So then you will definitely stay in the production. You will continue. The price here is what cost? What do you mean price is what cost? That was an interesting question. Just go through, take some time and go through it again. If you don't have the paper, that's there in whatever link I sent. Or maybe just get a screenshot of this. It's a good one. Question number 2 is a good one. Question number 5 is a good one. Others all have been repeated in earlier past papers. Okay, done. Last 2 papers. Moving on. Okay, 2019. This was one of the easiest ones, I think. Okay. Okay, distinguish between explicit and implicit cost. Come on, if you all can't do this, then there is again an issue. Explicit and implicit. Explicit cost are the direct cost, right? Where when you purchase inputs from outside the firm, whenever you purchase some inputs outside the firm, you have to pay money, right? So there is a direct cost, there is a direct monetary outflow that goes. What is implicit cost? Implicit cost is the cost of using the firm's own resources, right? Using the firm's own resources, the firm's this thing. Guys, remember in economics, when they say opportunity cost, it's explicit and implicit, right? Don't just say implicit is opportunity cost. Opportunity cost, there is an opportunity cost of explicit also, there's an opportunity cost of implicit also. Implicit cost, you can say, is the opportunity cost of using the firm's own resources. Explicit, you can say the opportunity cost of, let's say, paying money to outside, because whatever money that you pay outside, that money also you could have done something else, no? So that even that money has an opportunity cost. Okay. So you write the definitions, then they're asking what are some of your explicit and implicit costs as a result of your attending school, of you attending school. So what are the direct costs of you attending school? Where do you actually pay money for attending school? So let's say school fees, let's say transportation, let's say the stationery that you buy, let's say cost of, let's say, your uniforms and stuff, right? So those are direct costs. What are the implicit cost of you attending school? What do you think? Implicit, indirect cost. You can talk about, let's say, foregone income. Because you're going to school, you can't, let's say, go and work somewhere else, right? Not really. So go with this, go with the normal implicit. You have foregone income, let's say, um, what else can you say? Anything else? Subjects. Mm, what? Yeah, okay. So you can even take your time, right? Opportunity cost of your time, right? And things like that, right? So explicit is easy. Implicit, you can say your foregone time. You can say even the income that you could have earned and all of that. Okay. Okay. Part two, distinguish between a firm's short run from its long run. Guys, what is the difference between short run and long run? How many years is short run and how many years is long run? What distinguishes short run from long run? Exactly, guys. It's the inputs. It's the ability to change your inputs. So in the short run, right, there is at least one fixed factor. You can't change all your inputs, right? But in the long run, all your inputs become variable. You can change all your things. So you should say what distinguishes the main fact that distinguishes the short run and the long run is the ability to change your inputs. Then you say in the short run there are fixed factors, right? You can't change all of the inputs. So therefore, in the short run, you have variable inputs and fixed inputs. But in the long run, right, all factors could be increased. So therefore, all factors become variable, something like that. Okay. Four basic assumptions of perfect completion, guys. They're asking you for the four features of perfect completion. They're just using different words now. So features of perfect completion. Come on, if you can't do this, then there is a problem, right? Large number of buyers and sellers, homogeneous, perfect information, price taker, right? Free entry exit, right? All that you want. Okay. Just what you don't even have to explain. You state the four more than enough. Okay. Okay. Interesting question. I like these diagrams. Guys, these diagrams are the easiest to score marks, right? Because if you get it right, there's no way you can cut. Right? I think division class students, I've showed you 100 times what to do. I've showed you all steps of how to calculate all of this also. Okay. So diagram below represents a careful competitive firm operating in the short run, produce an equilibrium output of 100. So they're producing 100. So at 100 only, MR equals MC. So from that, you need to figure out that the price in this market is this. This is the MR. They're producing 100 because they produce at the profit maximizing output. So, okay. Okay. Then they're asking the total revenue received by the firm. How much is the total revenue received by the firm? Total revenue received by the firm. Okay, so first of all, you have to, this common understanding has to come that this is the MR is equal to MR is equal to AR is equal to price is equal to demand. That has to come. So how do you calculate total revenue, guys? Total revenue is average revenue multiplied by the quantity. So average revenue is 60, quantity is 100. So it's this box that is the total revenue. 60 multiplied by 100, 6,000. How do you find the total cost? Total cost is the average total cost multiplied by the number of units. So how much do we get there for total cost? So average total cost at 100 units is 40, right? So this, right, multiplied by 100, it's this area is your total cost. Simple as that. Total fixed cost. How do you calculate total fixed cost, guys? Now here, now they have not directly given you average fixed cost. How do you calculate this? How did I find the MR equals MC point? Because they say the equilibrium output is 100. So the firm is in equilibrium where MR equals MC. So here in this question, they're saying equilibrium is 100. So 100, I connect to MC and then I do the MR curve. Okay, so how can you find the fixed cost, guys? I think the easiest thing is, the fixed cost is, right? Okay, you all know this. Total cost is equal to variable cost plus fixed cost, right? So in this example, how much did we get as total cost? This font is small. Total cost 4,000. Okay, so total cost we got as 4,000. How much is our variable cost? Guys, can you see at 100 units, our average variable cost is 30. You connect to the ABC curve. So if the average variable cost is 30, the total variable cost is 30 into 100, that is 3,000. So plus the fixed cost. So now you can work backwards, right? So the fixed cost is equal to 4,000 minus 3,000. So the fixed cost is equal to 1,000. Simple calculation. Okay. So what is the economic profit or the loss? How do you find economic profit or loss? Economic profit or loss, very simple terms. It's your total revenue minus your total cost. So total revenue we found in the previous question, total cost we found in the previous question. You simply can get your answer. How much is our total revenue in this question? Part A was 6,000, right? So total revenue is 6,000. Total cost is 4,000. 6,000 minus 4,000, your profit is 2,000. That is this area in the diagram. So let me show it in yellow. This area in the diagram is your economic profit. Okay, so it's a very easy calculation where you can easily score 8 marks and it will not even take you a lot of time. Within, I'll say 4 minutes, you can score 8 marks. So you can use the, let's say for one question, you can use around 30 minutes. You can use the entire, let's say other 25 minutes maybe on just this 12 questions, 12 marks. So you can, even this, let's say this part 3, right? You don't need time to write the 4 basic assumptions. You don't need 10 minutes to write that, no, guys. Within 2 minutes, you can write the things, right? A large number of buyers and sellers, right? You can write, let's say, see, large number of buyers and sellers, homogeneous product. That I'll say maximum in 2 minutes. So that in 2 minutes, let's say this you take around 5 minutes, right? So 7 minutes. You have around 23 minutes left for that question to just to write this 8 marks. So come on, use that 23 minutes wisely and write as much as possible and explain your thing. You don't have to write everything you know, but in case you, let's say you are not sure on these two, then write more. So you have the time because you can save time from this and this. That is how you do it a little wisely. I'll tell you all later when you're nearing A levels how exactly to get it done and how to manage your time and all. Apart from that, yes. Fine. Yes. Any questions? No. Good to go to the next one, last one. Okay. uh okay, last paper, guys. Okay, small thing, revision class students, just wanted to remind you on your fees for March, right? We'll be sending the tudes of unit number 10, 11 and 12 once you all pay. We'll ideally be starting unit number 10, that is next Saturday, not this coming Saturday, that is the 13th. So we have a bit to finish in unit number 9, right? So we'll finish unit number 9 before the 13th somehow. And on the 13th, we will do unit number 10. So to do unit number 10 on 13th, the tudes will ideally be sent either on the 8th Monday or the 9th Tuesday. So if you pay your fees before the 8th or the 9th, I'm just telling you all now itself in advance, you all will get your tude by the 13th. If not, your tude will come next week only because it takes around 3-4 days. There is a holiday also in the middle, so the couriering company will not deliver tudes on that day. So please try if you want the tude, right? Your anyway deadline to pay is the 10th for this month. This month, once again to repeat, we will be doing unit number 10, 11 and 12, and we'll have a mock exam also, right, as a start for the fast track program to see where you all stand. From April onwards, we'll do the fast track. We'll revise the entire syllabus again, the hard questions to the papers to writing to all of that. So keep studying, doing your normal thing, and once you all pay the fees, please send me the slip. And also don't forget to fill that form, right? Because based on that form only we look and we send the tudes. I don't open each of your individual messages and then send the tude to you, right? Based on the form what you all have filled only, we send the tudes to you. So please give in two contact numbers, right? And also give in the proper address and do all of that. When I send the tute, I will let you know so that you know when you will get a call and when you can collect it. Uh, will I be able to join the revision class? Yes, you all can join. So okay, so any BYC student who if you all want to join, uh, your process is to uh pay the monthly fee of 1,800 and you all can join. Will you conduct paper classes? Paper classes in the sense this is the kind of paper class that we do. I'm doing it for free. The past papers. So mock exams and other papers and all of it will be covered in the fast track. So that will ideally be starting in April. That's a completely different thing. That's like a 3 to 4 month, not three, I'll say 4 month program where we'll be covering all the. It's not ideally okay. Just if you all are interested, I remember. Okay, some students ask me, guys, there is something called the. I'll give you all more information a little later, right? But there is something called a fast track program that I do. That is will start in April. It will go all the way until somewhere around, let's say, July, if possible even August, where we will be doing per unit. We will be doing yes, you all can join only for the fast track, no problem. Where we'll be doing 1 week per unit, right? So let's say classes on, I've not finalized the days. Let's say classes are every week on Saturday, Sunday, right? So uh fast track fast track guys is not free. So end of this month revision class is over. Fast track fee is going to be 3,000 a month. That's a completely different thing. 8 classes a week, right? 3 hours per class. uh 3 hours or definitely more than 3 hours. Sometimes it's hard to finish it in 3 hours. Definitely 8 classes, or sometimes we're looking at around 10 classes a month, right? Where each week we'll be doing one unit, right? So let's say on Saturday we do the, I'll teach the unit over again, all the main areas. On Sunday, I'm not finalized Saturday, Sunday, I'm just giving as example. On Sunday, we discussed all the key questions of that unit. The tough questions, not the baby MCQs that you will find, the hard MCQs, the hard essay questions. You all will have a paper kind of thing, right? So one unit is done. You will get a study plan on what to study on what day, how to study, how to plan it all. All of that will also be sent. So likewise, every week we'll be doing one unit. So 12 weeks, 12 units will be done. So that is 3 months. And then month 4 and month 5 will be complete mock exams, right? So I'm planning to do around 8 mock exams. Definitely the mock exams will be harder than A levels. I have 4 with me right now. I'm still preparing some more, right? You'll prepare. So I think after doing 8 mock exams, I don't think there's any other question that you will not be able to answer. Your A should be guaranteed. There can be one or two questions that comes from nowhere out of the blue moon, but it's your goal is you don't have to get 100 out of 100. No, at least you should be able to at least score 98 or even more, 99. That is okay. Monthly payment is also there for a fast track. Yes, guys, fast track there is a monthly payment. We print the tubes and we send. That is not BYC. That is not the revision class. That's a completely different thing. Okay. So just told you because there was a lot of students who asked me, guys, and also one more kind request, right? Please read the messages that is there on the group, guys. If there is a change in class time, if there is a class, I will inform in the group, right? Because without reading, don't just try to drop me a text personally because sometimes I might be busy and I might not be able to reply. So we have a group to communicate. That is why I put the message on the group instead of individually texting you all 100 people. Just imagine 100 people texting me and asking if there is class or what time is class. That takes around 20-30 minutes for me to reply to all of that. I don't have that time. So if you have a doubt or a question, first check if there is anything on the group relating to that. If not, please ask me, no problem at all. Okay. So that is that thing. No questions, right? Can we do the last paper? Yes. Fine. Can we move on? Yeah. Okay. So the last question of 2020. What is the production function? Distinguish between short run and long run production function. Did we do this question? I think the exact question was there before, right? I showed you short run production function. Remember we had that argument L and K, and can you put this thing? Yes, remember that question? No, don't remember. It was there, right? Same question that is there. So what is the production function? You can say production function shows the relationship between the inputs and the outputs of a firm. So short run production function, you can say in the short run, they use both variable factors and fixed factors. The short run production function, you can write it down. Long run production function, you can say all factors are variable. You write it down, right? So I'm not going to explain. Reasons for economies of scale and diseconomies of scale. Okay, this is a, I think this is a part that is a little new, so that is why I included. And even the third question is very interesting, right? I'll explain. Reasons for economies of scale, guys. What are economies of scale? Economies of scale is where, right, the firm becomes, let's say, a very large firm, right? They become a large firm, and then what happens? Their average cost is falling. So why is their average cost is falling? Okay, so because of certain reason. Give me a second. Okay, so the average cost can fall because number one, of managerial economies of scale, right? Where they can get very good managers, even the manager's salary is being fixed, right? There is marketing economies of scale. There is technical economies of scale, right? You have purchasing economies of scale. You have financial economy. Remember, I explained this before, right? Didn't I? In one of the papers, I explained this in detail. What does managerial, marketing, technical? Yeah. Hope you all would have written that down. So that is that part. And then you have this new part. Okay, see now see, think that you are actually doing the 2020 paper, right? I'll tell you, if you have done past papers, the only question I feel that was a little challenging in this paper is this. Even that is not that challenging, but the others, one, two, now see, what is economic rent, right? Remember in the previous question also, previous paper that we just did, right? 2 years before, they asked question on economic rent, and under what conditions a factor of production can earn economic rent, right? And how do you derive the industry's short run supply curve from a short runs from the firm short run supply curve? This is also a very easy question. So I think the only new one is this third part. So you can easily score at least 17 to 18 marks. Remember, if you can score at least more than 15, you are guaranteed of an A. Guys, 15 marks will definitely be there from past papers itself. Whether you get that higher A or not will depend on can you use your common sense a little and have you studied the unit properly. Okay, so then what are the reasons for diseconomies of scale? That is what I wanted to highlight. Guys, diseconomies of scale may be one, it can be because of communication, where when you're a large scale production, right, where it becomes very hard for you to risk bearing efficiency is correct as economies. Yes, risk bearing efficiencies also can come under economies of scale. In there, this is just a screenshot I got from the internet, so that's not there, but you can. Okay. So reasons for diseconomy is you can talk about, it doesn't have, there is no reason like this. You can explain these points, right? So you can say communication problems, right? Where when there are large scale producer, where the price of the average cost tends to increase because you need a lot of communication now. Let's say if it's a small firm, right? You can simply, let's say, communicate with the 10 people that is there. But now let's say you have around 100 branches. Now let's say you have to make a system to communicate. You need to have, let's say, give everyone phones, let's say laptops, right? All of that, there are communication issues. Then coordinating, you need to appoint people to coordinate. That gets hard. Again, there can be average cost increases, right? Then you have X efficiency, where management cost increase, that's not really in your syllabus, not really needed. Then principal agent problems, so there can be different reasons like that, where you have diseconomies of scale. Yes, you can say technological inefficiencies, managerial inefficiencies, all of that also is possible. Okay, Then this one, anyone knows the answer for this? Without going through, okay, I know you would have gone through the answers now, but relationship between economic profit, producer surplus, and fixed cost. They're not asking you to distinguish, they're asking you for the relationship. So you need to show how these three are connected. If they say distinguish between economic profit, producer surplus, fixed cost, you can write the definition of these and you can explain. But here they're asking you for the relationship between the three. So what is that? Anyone who knew this? Okay, at least did you all go through the answer? Yes or no? Went through the answer? Yes, no? Went through the answer? No. Okay, so at least did you all okay, anyone who had an idea about how to write this before going through the answer? Marking scheme was there on the group. It was there on the revision class group. No? Difference between economic and exactly. So listen to me very carefully. It's an interesting story, right? Relationship between economic profit, producer surplus, and fixed cost. Okay. So how do we get to economic profit? Okay. Economic profit. What is economic? Okay, this is annoying. Okay. Economic profit. Economic profit here I'm talking about what is economic profit here? Remember we talked about economic profit earlier. Economic profit is where the total revenue exceeds what? Total revenue of a firm exceeds the total, guys, that is normal profit, guys, minimum payment for the entrepreneur, not economic profit. Economic profit is where the total revenue of firm exceeds the total cost. So then you can say total cost, right? Total cost is a combination of variable cost and fixed cost. Is that part fine? Economic profit. Yeah. Then remember producer surplus. There was a way of calculating producer surplus. Connection, producer surplus, variable cost. There was a connection. What was that? What was producer surplus? Producer surplus. You can say producer surplus is the total revenue minus the total variable cost. Remember, there was a different way of showing the producer surplus as total revenue minus the total variable cost. If you can't remember, go check unit number 2 and 3. There is a way like this as well. I remember I explained this somewhere. I can't remember to whom, but I remember I explained this somewhere. Right? That producer surplus is the total revenue minus the total variable cost. So even if you look at the, let's say, diagram, right? Demand and supply, right? This part is producer surplus, no? Right? This entire box is total revenue. This part, this is the minimum that he wants to cover, no? This part is his variable cost. So from the total revenue, that is this box, if you deduct the variable cost, you will get the producer surplus. So producer surplus is the total revenue minus the variable cost. Economic profit is the total revenue minus the total cost. Okay. So which one is higher? Economic profit or producer surplus? Which one do you think will be higher? Which has a higher value? It's producer surplus which will be higher, right? Because economic profit from total revenue you minus fixed cost plus variable cost, so you get a small amount. But in producer surplus from the total revenue you only minus the total variable cost. So you can say producer surplus is higher than economic profit. And what is the difference? What is the difference between the producer surplus and the economic profit? Is equal to Your final point means the difference between the producer surplus and the economic profit is the total fixed cost. The difference, right, between the producer surplus and the economic profit is the fixed cost. So for producer surplus, from producer surplus, if you can minus the fixed cost, then you will get economic profit. Or for economic profit, you add the fixed cost, you will get producer surplus. The difference between economic profit and producer surplus is the fixed cost. So that is the relationship between those three. Got it? Yes, no? It was a nice question. Something, it's not a total hard question. It's interesting and a nice question. Yeah. So you can have, right? You can have a question like this that sometimes comes from a little nowhere, not nowhere, but that is not that has not really been tested, let's say, in a past paper before. So there can be a question like that. Go through that. Okay, so that is done. Then we have this. Okay, what is economic rent? Now you all know what economic rent is. This is whatever an factor owner uh, earns more than, right, more than his minimum payment that he wants, right? The more than the minimum payment, if he earns anything, that is what we call economic rent. So under what conditions a factor can earn economic rent? You should say the ability for a factor to earn an economic rent will be based on the elasticity. So you can say, now remember that elasticity story I explained before. Okay, so here you can say, right? So you can say if supply is perfectly inelastic, right? If supply is perfectly inelastic, the total earnings of that factor will be economic rent. When supply is perfectly elastic, right? The economic rent earned by the factor will be zero, right? So you can say in any situation in between that, right? The total earnings of the factor will be split between economic rent and transfer earnings. So giving you a final conclusion saying a factor of production can earn economic rent as long as his, let's say, supply is not perfectly elastic. So in any other situation, he earns a economic rent. So you can even draw a diagram there and you can explain. So that is what is required in that question. What is economic rent? Under what conditions can a factor of production earn economic rent? So as long as you say if it's perfectly elastic, you won't earn. If it's perfectly inelastic, entire factor earnings is economic rent. In any other situation, you can have either economic rent and transfer earnings both. Answer for the third one is this. Okay, is that question fine? The economic rent one? Any doubts there? I explained it before, that's why I didn't go into detail. Fine, yeah. No questions. Okay, no questions. Okay, and the final one. How do you derive an industry's short run supply curve from the firm's short run supply curve in a perfectly competitive industry? Illustrate your answer with appropriate diagrams. This was the same question that was there in 2013, right? In 2013, they asked how is the marginal cost something? Just check. Can't remember the year. I think it's 2013, 2015, 2013. Yeah? 2013. Okay, here. Discuss whether in 2013, the same question, discuss whether there's a relationship between the marginal cost curve of a firm and the supply curve of the industry. So marginal cost curve of a firm is the supply curve of the firm. Marginal cost above the average variable cost is the supply curve of the firm. So then the total of all the supply curves of one firm is the supply curve of the industry. No? So how do you derive the industry's short run supply curve from the short run supply curves in the perfect company industry? First, you can start off saying the short run supply curve of a firm in a perfectly company industry is the marginal cost curve above the average variable cost. Therefore, to derive the industry's short run supply curve, we need to add all the marginal cost curves above the average variable cost. Or in other words, we need to get the addition or the sum of all the supply curves of the firms, right? So you explain that story and then you can illustrate it with a diagram. So diagram, know the diagram? No, you want me to show you the diagram? Let me see if I can Google a diagram. I can't draw a diagram. Give me a second. Mm, okay, so let me see if I can find a nice diagram. Mm, I want the diagram. Okay, here. So you can even look at this. Okay, this is an interesting one. Give me a second. Okay, the image is not that clear though. Let us see if I can get a clear image. Hold on. Okay. Okay, so if you look at this image here, now here, can you see this red one highlighted here is the marginal cost curve above the ABC. So in other words, that is the supply curve of the firm. Can you see here, this supply curve at price 10, they are talking about some calls here. So just think of the quantity. Quantity is 14. So if you look at the industry supply curve at price 10, it's not 14 here, it's 280. So that is how did this 14 become 280? Because the industry supply curve is the addition of all the individual supply curves. So when you add the at price 10, this firm is willing to supply 14. Another firm will be willing to supply, let's say, another quantity. So if you add all of that, right, at price 10, the entire industry is willing to supply, let's say, 280. So if you can draw a diagram like this, you can get your full marks for that question. Is that okay? Yes, questions, no. Part 5. Ship. Okay, fixed cost is a doubt. Fixed cost is a doubt in which one? Sorry, I saw this. No questions, right? Can manage. Guys, please, for God's sake, right? So there is no fixed cost. So fixed cost is the difference between these two. No? It's the easy thing here. So here, economic profit is your total revenue minus your total cost. That means total revenue minus variable cost and fixed cost. Producer surplus is your total revenue minus your variable cost only, right? So the difference between this and this is that in economic profit we minus fixed cost also. So that is what I'm saying. The difference between producer surplus and economic profit is the fixed cost. Okay. Okay. So this unit I think is marking scheme for 2020. Guys, can someone send? I don't really have the pictures. I remember someone sent it on the group. Someone sent it to me also. Guys, if anyone has the pictures of 2020 marking scheme, just put it on the group. And also, guys, the BYC, I think group 2, I think only admins can text. Guys, I made it only admins to text because just don't share anything unwanted, right? I'll make it open to anyone, right? Just keep it normal. Anything, let's say your school event or let's say a seminar or those things are fine, but don't really get into nothing into politics, nothing into anything racism to anything. Just don't keep it that because that is just our group. Anything that would help you in A levels, please do share, but nothing apart from that, right? Not really let's say, okay, just you all know what not small kids now, guys, right? So I'll open the group, but please make sure you don't use it for a thing to share anything unrelated. Okay, right. Okay, I think I have a PDF. I'll send the answers of this. So guys, what you do is now, right now, since we have done entire unit 4, please take, let's say, a day or two and go through all these unit 4 questions that you did, right? All the MCQs, all the essay questions, right? So I have the explanations of all revision class students. You all have the recordings of all as well, right? So all the MCQs we did, all the essay questions we did, right? Please go through it all. Make sure you're fully okay with the unit, right? So clarify it completely and then finish it off. And also, by the time you come on Sunday, please do the unit 5 national income accounting MCQs and come. I think there will be maximum, I'll say, around 30 to 40 MCQs only, and you all can do it fast. So it will take around 2 hours maximum to do it, right? Please study national income accounting, do the MCQs and come, so we can discuss it on Sunday, normal time, 2 to 4 p.m. Right? So I'll send you the answers. I think I have the answers. Uh, yeah, that's it. Any other questions? No, right? Ship. So if that's it, I'll end it from here. If you have questions, you can stay and clarify. If not, thank you for coming. I'll see you all on Sunday.